You finally did it. You saved up some money. Not life-changing money, but enough to feel like it shouldn't just sit in your bank account doing nothing. Then someone tells you about a private lending opportunity. They say it pays 12% returns. It's backed by real estate. It's safer than the stock market. And suddenly, it feels like you found a shortcut to passive income. No market volatility. No complicated charts. Just steady returns. And you start thinking, why isn't everyone doing this? If that thought sounds familiar, you're not alone. Private lending can be a powerful wealth-building tool. But in 2026, it also carries hidden risks that most new investors never see coming. My name is Noah, and I spend way too much time thinking about how people build wealth without fully understanding the risks they're taking. If you're tired of low bank interest and tempted by high-return opportunities like private lending, this video is for you. Private lending is not a scam. Wealthy investors have used it for decades. But here's the difference. They use legal teams, risk models, and diversification. New investors rely on trust and optimism. And that gap is where problems begin. The first hidden risk is illiquidity. Private lending sounds flexible, but once your money is committed, it's locked. Imagine lending $10,000 at 12% for 1 year. On paper, you expect to earn $1,200. Everything looks simple. Until month 5, an emergency happens. A medical bill, car repairs, job instability. You ask for your money back, but the borrower says it's tied up in the project. Because it is. Private loans are not like stocks you can sell instantly. Your capital is stuck until the loan term ends or the project completes. Most people believe they won't need the money. But life is unpredictable, and overconfidence makes us underestimate future financial stress. The second hidden risk is the illusion of safety from collateral. You hear that the loan is backed by real estate, and your brain translates that into safety. But collateral is not protection. It is a process. If a borrower defaults, legal action begins. Foreclosure can take months or even years. Legal fees accumulate. Property values can fall. Holding costs add up. Let's say you lend $50,000. The borrower defaults. Legal and holding costs reach $8,000. The property value drops 10%. You may recover far less than you expected, possibly losing a significant portion of your capital. Physical assets feel safe, but safety depends on liquidity, legal enforceability, and market timing. The third hidden risk is borrower risk. Banks use entire departments to evaluate borrowers. Private lenders often rely on conversations, referrals, or gut feelings. But you're not just lending to a deal. You're lending to a person's behavior under pressure. Trustworthy people default all the time. Not because they want to, but because projects run over budget, markets shift, or regulations change. Here's the math. If you make 5 loans of $10,000 each at 12%, you expect $6,000 in annual profit. If just one loan defaults and you recover only half, you lose $5,000. One default can erase an entire year of gains. That's not bad luck. That's mathematics. The fourth hidden risk is the return trap. If private lending pays 10 to 15%, why aren't banks doing all of it? Because higher returns usually signal higher risk, weaker borrower quality, or lower regulation. When savings accounts offer only a few percent, double-digit returns feel irresistible. This is called yield hunger. Investors chasing high returns often ignore concentration risk, legal complexity, market cycles, and the possibility of fraud. You may hear success stories from friends making great returns, but you rarely hear from those who lost money. That is survivorship bias. Private lending appeals to smart investors because it promises control, predictability, and passive income. But in reality, it combines credit risk, legal risk, liquidity risk, and market risk. The same risks banks spend billions managing, and you're taking them on a loan. Let's compare 2 simple scenarios over 3 years. In the first scenario, you invest $30,000 in private loans at 12%. One default occurs in year 2 with partial recovery. After losses, your ending value is around $33,600. In the second scenario, you invest the same amount in a diversified index fund earning 8% annually. After 3 years, your ending value is around $37,800. Lower returns on paper, better outcome in reality. Risk management matters more than return percentages. This doesn't mean you should avoid private lending. It means you should approach it like a professional. Diversify instead of concentrating your capital in one loan. Demand proper legal documentation and collateral registration. Stress test every deal by asking what happens if property values fall or projects are delayed. Maintain liquidity and avoid locking more than 20 to 30% of your investable capital. And most importantly, price risk realistically. A 12% loan may net closer to 7 or 8% after delays, costs, and defaults. Here's a quick story. An investor lent $15,000 to a small developer building 2 homes. The project looked solid. Permits were approved. Demand was strong. Then a regulatory delay halted utility installation for 10 months. The developer didn't default, but interest payments stopped. After legal consultations, delays, and stress, the investor was repaid. But the true return, after costs and time, was just over 3%, lower than a savings account. Private lending isn't dangerous because it always fails. It's dangerous because it looks safe. The biggest risk is not losing money. It's misunderstanding risk while chasing yield. If you approach private lending with diversification, legal protection, and realistic expectations, it can be a useful tool. But if you treat it like easy passive income, it can become an expensive lesson. In 2026, the goal isn't just making money. It's making sure you get to keep it.